This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and this week's returning guest is my good friend, Jay Conner. Jay has been a successful real estate investor, buying over 400 properties over the last 14 years, and his superpowers include raising private equity, real estate automation, and buying foreclosures. He is also a commercial developer, a national speaker, and is the best-selling author of The New Masters of Real Estate, Getting Deals Done in the New Economy. Now, I've known Jay for a number of years, and he and I get together about every 3 months through a mastermind we are involved in, and I can honestly say he is one of the most approachable and likable guys I have the honor of associating with. And on this podcast, we take a deeper dive into how to raise private equity in today's economy. So without further ado, please enjoy my wide-ranging conversation with my good friend, Jay Conner. Jay Conner, my friend, welcome back to the show.
Well, hey there, Scott. Thanks for having me back. You must not have been disappointed the first time. So anyway, I'm excited to be back here to talk with you about my favorite subject, private money, private equity, syndication, and all that kind of stuff. And, you know, what's going on in this crazy market these days.
Yeah, well, I've given everybody a little bit of your background again. And if they hadn't caught you the first time around, you can go back and listen to that podcast, and we'll give that to you in the show notes. But, you know, Jay, I've given everybody a little information about you. Why don't you fill in the gaps? Let us know what you've been up to since the last time we chatted.
Sure. Well, since the last time we chatted, I got a good problem. I have got more private equity, private money, private lending chasing me than ever before. I started, raising private capital in 2009, started in the business in 2003, as you already told everybody, but started raising private capital. And I think I partly know why. And maybe you can help me. I think the reason, I've got a good problem. Literally, I have got millions of dollars, what I call sitting on the shelf. In other words, it wants to be deployed, but I don't have a project or houses for it yet. And I've never had this much money, private money available. And of course, we're talking about from individuals. We're not talking hard money lenders and all that stuff. We're talking individuals. I think part of the reason, Scott, and regardless of your political affiliation, it doesn't matter with what I'm getting ready to say, because what I'm getting ready to say is just facts. Never before in a political administration has there been more money printed in the basement of the White House, and I'm being figurative, but there's been more money printed in the time that the current administration took office than ever before. And so here's the deal. There's so much money. I'm talking not only retirement funds, but I'm talking liquid capital. There's so much money on the street in people's hands. They don't know what to do with it. Of course, that's what's driving our inflation problem. But they got so much money, they don't know what to do with it. And so now I'm having more and more and more opportunities, doing my best to help people figure out how to safely and securely invest their funds. So, I've never chased anybody for money. I've never pitched a deal. They chase me. But never before have I had this kind of an opportunity to assure people that, hey, we have a way for you to use your funds, your liquid capital, your retirement funds. Just give me a little bit of time and, we're going to be able to put it to work for you. So what's happened since we talked last time? There's more liquid capital available than I've ever seen, at least in my investing career.
We're seeing the same, and not only that, you compound that with the fact that everybody is exiting the stock market now, and they're looking for yield. And those of us that are investing in real estate, we know that we provide it. People can see it, touch it, feel it. They're looking for a hard asset. Income-producing hard assets are what is at the top as well. And so it is a unique time that we're in right now, and that's which is really why I wanted to get on this call, Jay, because you're out there, and we're doing the same thing, but in different markets, and we've got a different group of folks, and we've got different asset classes that we're backing it by, and even though what we do is very, very similar, it is a little bit different. You've got a lot of perspective. You and I have both been through. This will be our third recession, at least my third recession, and maybe one more for you. I'm not going to guess that that's the case, but we learned lessons from the last two. And this one is already shaping up to be a little different. And so that's why I wanted to reach out to you and have a call for Storage Nation to listen in on. Tell me what you're seeing on the front end of this as we head in. What are you seeing that is different? And maybe even some, if I could be as bold as to say, what are some of the predictions and that you have for this recession, and how does that affect your approach to it in raising capital and doing deals?
Scott, I've been very blessed on my podcast to have some very smart economists, smarter than me. I mean, their crystal balls have got more crystals in their balls than my balls have crystals. But I've been very blessed to have them on as guests. And here's what I'm hearing from the experts. And let me just go ahead and frame this. Nobody really has a crystal ball. I mean, really, nobody has a crystal ball. I mean, who in the world other than God himself knew what was going to happen with real estate prices during COVID? I mean, my lands. Nobody that I heard of predicted that. But that being said, I've talked with some very smart people that have got a pulse as to what's going on. So let's talk about recession. Are we entering a recession? Well, first, let's define the word recession, or what kind of recession. There's different kinds of recession. There's a recession of where people pull back, stop spending money, things slow down in general. But then there's this other thing called a real estate recession. So one of the smartest guests I had on recently, here was his prediction. And he backs it up with some very sound thinking. He says, first of all, recession in general. We've already started entering into a recession in general, generally speaking, all right? Not bad, but to some degree. On the other hand, when it comes to real estate recession, in other words, is there going to be a crash? Is there going to be a bubble burst? Like we experienced back in 2008, 2009. Well, first of all, Scott, as you know, as well as I do, if not better, the situation that we're in today with foreclosures and all that stuff is for a completely different reason or reasons than it was in 2007, 8, and 9. I mean, go back to 2007, 8, and 9. The big reason for those foreclosures were you had millions and millions and millions of people that should have never gotten a mortgage to start with because of fraudulent, verifications of income, stated income programs, and all that. Well, at least for the time being, Wall Street wised up to that. So what's now happened, and this foreclosure thing that we got going on has now been driven by COVID. So we have two different categories of foreclosures. One category are those, and I'm talking single family houses. So you got that category of people that were already entering foreclosure prior to COVID. My definition of COVID starting in the financial market is really March 2020, and the health market as well. So since March 2020, you had those people entering in foreclosure that were already entering regardless of COVID. So all those were put in moratorium. And then you had all those people during COVID that lost their jobs. People had to stay at home. Some companies did not pivot, can't do Zoom. You certainly can't do hotel on Zoom. You can't do restaurants on Zoom. All that hospitality industry, imploded for quite a while. And so you had all those people lose their jobs, go into foreclosure. So you got those two categories. Well, in the past 2 months, here are the headlines from the experts. Foreclosure, and I'm talking about Fortune magazine, I'm talking about people smarter than me, but the foreclosures that are opening up and that are predicted to happen this year, we're talking at least 167% over the last couple of quarters. And the reason for that is that all moratoriums have been lifted. Now, I do not believe the banks are going to open up all those foreclosures at once, or that will cause them a big problem and will reduce prices even further. So I think, and I really don't think, based off of everybody I've talked to, we're not going to see what we experienced in 2007, 8, and 9 as far as the number of foreclosures. But there's going to be more opportunities there this year than we've seen in a long, long time.
Yeah, so I wanted to touch on that. Here's one of the things that I'm hearing, and I don't follow necessarily the foreclosure market, especially on the housing side, but I've heard that this time around the banks are going to do their level best to stay away from the actual foreclosure process. The big banks saw what their cohorts did to be a little more nimble and just going through short sales. Any other means other than dragging it out and paying attorney's fees? Are you hearing and seeing that as well?
Yes. Mm-hmm. Yeah, I agree. Now, we have this other thing. You got the general recession, but then you have real estate recession. What I'm hearing is, now, are some markets already seeing a reduction in prices? Yes, some markets are. But generally speaking, including my market, here's the deal. You got mortgage rates going out the ceiling, okay? And I'm talking on residential houses now. You got mortgage rates going out the ceiling. Is that going to reduce the number of people that can buy a house? Sure it is. On the other hand, we got this, there's so many variables. We got this weird dichotomy going on. Even though mortgage rates are raising, not as many people can afford to buy a house as even 6 months ago or 4 months ago. But we still have this thing called inventory. I just heard an expert last week tell me that right now there's a 4 million household shortage of people dying to get a house to live in. I have never seen in my career so many all cash offers. All cash offers. Where are they getting the cash? I don't know, other than the White House printed it. All cash offers, no appraisal contingency. Listen, 48 hours ago, in fact, 48 hours ago and 30 minutes from now, we closed on a property that should have appraised, if they were getting a mortgage, should have appraised for about $155,000, $160,000. Little 3-bed, 2-bath house here in my little area. They paid $205,000 cash. It's supply and demand. Supply and demand. I just sold a house over here on 1010 Oak 3 weeks ago. My realtor told me that, Jay, this house might appraise for $460,000. All cash, closed out $505,000. And 18 months ago, it was worth $375,000. 18 months from 375 to 505. So let me just bring this to a conclusion as to what I'm hearing. What I'm hearing is, because of supply and demand and the amount of money on the street, overall, and I could be wrong, but overall, real estate prices and values will continue to stabilize and increase somewhat for the next year to 2 years. Here's where people sort of get their minds confused. In fact, my mind was confused until a smarter person than me cleared it up. When you've had increase in prices, real estate prices, over a 12 to 18 month of 25%, 25%, which is, I've never seen that. I've never seen that ever. And then it pulls back, as it is now, to not a 20 or 25% increase in prices a year, and it pulls back to an increase of 6% to 7% increase the next year. You feel like you're in a real estate recession because there's a big difference between prices going up 20 to 25% in the year to going up to normal again of 6 to 7%. So it's that perspective, if you will. And along with that, don't see the bubble, don't see the crash, all this and that. Wall Street's a whole nother conversation that I'm not even smart enough to talk about, but I am smart enough to talk about this real estate thing. So all that being said, I think we're going to now see a stabilization. In fact, I just had a closing in my attorney's office this morning, all funded with private money. And I said, Julie, is it starting to slow down for you at all? She says, not yet, but she says, I am seeing in my August closings and schedulings a little pullback, here in our area. However, summertime is hot. So I'm not preaching doom and gloom. I'm not hearing doom and gloom, but I am hearing caution. Do not invest in real estate, in residential anyway. Your self-storage is a whole different world. But in residential, don't invest today like you did a year ago, looking for that 20% increase on a flip. I tell you, one of the biggest mistakes I made, Scott, I'm going to shut up here in a second and let you talk. But one of the biggest mistakes I ever made as a real estate investor was back in 2004, prior to, the 2007, 8, and 9 crash. I invested in this property, and man, values were going up. If you could fog a mirror, you could get a mortgage. And I invested in this property, and it was a luxury property over on Atlantic Beach, right on the ocean. And here's my mistake. And I want your listener, do not make Jay Connor's mistake. I invested in that property with one thing and one exit strategy in mind. The number one's the most dangerous number in any business anyway. I had one exit strategy, and that was I was going to flip that thing. I was going to turn it into a beautiful property and sell it. Guess what, Scott? By the time I got it renovated, I got it all beautiful. I put it on the market. Prices had already started to come down. I had my blinders on. I was like an ostrich with my butt in the air and my head in the sand. And I wanted to get my price. 6 months later with it on the market, guess what? I couldn't even rent it out and cover my underlying debt. Lesson learned by me. Lesson learned. Always calculate you being able to hold a property and cash flow it, even if that's not your intended exit strategy. Because you might be stuck holding something that you weren't planning on being stuck with. Calculate it both ways, if that makes sense.
It makes complete sense. And as we talk in our circles and educate folks and just have general conversations, you should never have one exit strategy to begin with. And, that second or third exit strategy may be a long-term hold and then sell. And then therefore you have to then calculate, as you mentioned, your hold strategy, and does it cover, do we have a debt service coverage ratio, and, what do you need to do in the meantime? So all important. And, I guess to tag on to that, there's a whole lot of folks that not only investors, but also syndicators and promoters that I feel have maybe been a little too complimentary of their own skills, and they've had this wind in their back and in their sails of a great market. And as a person that we both know very well, Jay, has said, hey, don't get too big on yourself here, big head. 50% of that was the market. And I do fear that some folks are going to head into this market and just assume, also put their head in the sand and just assume that everything they touch just turns to gold, and they'll continue to produce these same types of returns. And that's dangerous as well, because now all of a sudden our exit ramps are being shut down. We're not going to have as many, and you're going to be chasing value, and that is a nasty place to be in what we've seen. This is an unprecedented inflationary period that we're heading into right now, and yes, real estate lags behind that, and it is a hedge. However, I see we're going to, eventually we will see a drop in values. Eventually people will really slow down in terms of buying, and we'll see those valuations come down pretty quickly. So if you're tight on your margins, you need to continue to recalculate and calibrate to what the market is right now, and that means last month. What did you sell last month, and how did you do compared to the month prior, and where are rates right now? So I coined a phrase, and I don't know if it's new or if it'll stick. I guess I'll claim it at any place I can while it's being recorded, and that is a dynamic underwriting. We have dynamic pricing at the airlines. You buy a seat this week, and it's going to be more expensive next week the closer you get to your flight. We do that in self-storage, and as we get more full, we have dynamic pricing. The price goes up as supply and demand. And I think we need to continue to underwrite and look at our properties and our projects that way as well, constantly, not only on an acquisition, but also on a hold and an exit. We have to go back and take a look at and plug in, those numbers that are relevant today to determine where we go next and or whether we need to go forward or not. I mean, things are changing so fast right now. You're 90 days into a contract before you close on it. You best be underwriting again, 2 weeks before closing to make sure you still want it.
Absolutely. Well, Scott, this is your podcast and you're interviewing me, but you know a lot more about commercial than I do. I've done commercial. I've got a shopping center free and clear. That's a nice one. I've done condominium developments and et cetera, but you've done a whole lot more commercial than me. I gave you my crystal ball on this residential end of things. Where do you see, and this is for my benefit and your listener as well, but what's your crystal ball saying on commercial? I mean, apartments, self-storage. I mean, I hear there's a big shortage, even still yet, on rentals, whether it's apartments or single-family houses. Where do you see things the next year or two on the commercial end of things?
Yeah, so we follow all asset classes, all food groups, because we're kind of competing against them. We are a financial services company essentially that deploys capital, and we back it with self-storage because it produces the highest returns. We've seen historically that self-storage has done extremely well. During good times, inflationary periods, people store more stuff, and then in a downturn, when people downsize and businesses downsize, they put their stuff in storage as well. And so it is an incredible hedge against what's going on in the market on both ends. In comparison to the other asset classes, that's why this recession is a little bit different, and that's because there's an undersupply of everything at this point, and that's because of the shortages and the cost and the backlog of everything, supply chain issues. I'm so tired of hearing that. And that's because we're living it as well. So that's a real thing. So all those are behind. There's a shortage of workforce housing, people that want to buy affordable housing just to live in. There's a shortage of rentals for those whose credit is such or their financial situation is such that they can't own. It's the same thing. And so, we know some friends that are addressing that head on as well. And time will tell as to how profitable that will be. And there's always going to be a ceiling to how much somebody can afford to live. In self-storage specifically, and then I'll touch on some of the other asset classes, people are storing stuff. And so this is demand driven by factors that are, occurring in life. There are life decisions that are creating a demand for storage. When people are in transition, when they're downsizing, they have to move, or they choose to move, or their basement floods and they need to put their stuff in storage for a while. They're remodeling their house. They're moving back home. Somebody passes on and they're settling the estate. Some things go into storage. Somebody has to move out because they were doing something that their spouse didn't know about. And now they find themselves living with their friend on the couch. They have to put their stuff in storage. I mean, there's a number of life events that cause the demand for storage. That doesn't change, but also it's affordable. So it's not like you're going to change your status, where you're living, unless you have to move in with somebody else. But with storage, that kind of ebbs and flows. It's $100 a month, it's $150 a month. Some parts of the country is $200, some parts of the country it's $50, and so that's pretty constant. We know that there's an uptick in demand during a recession, but it's not such a large budgeted amount in somebody's monthly outtake that it goes away. So it's not going to be affected as much to the negative. We did see that a little bit, Jay, in 9 and 10 as that recession wore on, and as it took a while for the jobs to come back. Some people were faced with the fact that, I do need to either throw some things away, or I need to, cable, and stop paying for Netflix. And we know that nobody's ever going to stop doing that. And so the storage went. So they figured out a place to put stuff, or they threw it away. But that was like 3 years later, and that was the nuance of that recession. So again, we're not blind to what is coming down the pike. We're going to take a look, at all factors as to how this recession is going to play out. But I do feel that, again, my crystal ball is in the shop as well. I don't get it too much. But if history repeats itself, I think that this is going to look a little bit different than the last one. Right now, it's just interest rates on the front end, and lenders are still interested in self-storage and allowing us to develop and acquire. So I don't know that it's going to be as steep. Now, on the industrial side, we've seen a real fragmenting of the workforce is now very, very fragmented. people have gone home to work, and businesses recognize that, hey, we don't have to, they were forced now, even though they thought it was a good idea before, but they couldn't do it. It wouldn't work for our organization. People have to be in the office. The fires burn hotter when the coals are closer together, and we have to have our team together. And then they realize, oh, people are more productive and they're happier at home. Let's get rid of this office. And so then people began moving, and it created a demand for storage, but also it regionalized a lot of warehousing and businesses. And so we saw a lot of industrial being built and office buildings that were smaller, a lot more shared office space. The WeWorks of the world were created and built. And so I still think that's a viable concept for entrepreneurs and also businesses who now don't want to build a building or take on a long-term lease. They can move into that shared office space, and they can lease out 10,000 square foot of a warehouse instead of building, 100,000 square foot and owning it. And then when things slow down, they're stuck with it. So I think that people are making more decisions to buy smaller facilities and for shorter time frames, less commitment, I guess, is probably the overarching theme that I'm seeing right now, because you can definitely get your head over your skis pretty quick. And I think some folks are still stinging and learn that lesson last time around.
Right. Part of what drove my question is, Carol, Joy, and I, we live in a very small market. I mean, 40,000 people here in our market where we invest in. And as of about 9 months ago, Scott, I've never seen so many brand new construction self-storage facilities being built from the ground up. And I'm talking nice. I mean, these are like super nice. Yeah, I think Pinnacle has got like three brand new ones going up here. And look, I'm talking, and they're all right on the highway. You can't miss them. They're all right on the highway. And you can tell these ain't mom and pops right here. They're all climate controlled, and they look like these beautiful contemporary buildings. And you drive by at night, and they're all, lit up like Las Vegas and stuff. And I'm going, why all of a sudden are all these? I mean, I know this demand did not happen like overnight. So it's like, why am I seeing all these self-storage brand new constructions like going up everywhere around here? I mean, have we had a shortage all this time? Who knows?
That is part of it, believe it or not, Jay, is there has been a shortage even since the last recession. Construction stayed at a minimum for so long that, we've had a hard time keeping up with demand, period. And that, and a result of the increase in demand, now is driving rates up in all markets. And so when you see, it really is a function of the rates. When you model this out in terms of whether you're going to develop a facility, you work the math backwards. How much is it going to cost to build it? What are the rental rates in the market? And if I'm at 90% occupancy or 85% occupancy at this rental rate, the street rate in this market, is that enough to cover my costs? Work backwards, pay the loan and everything else. And so it's an elaborate formula, but self-storage is somewhat of a simple, predictable business model. Don't confuse that statement, folks. It's not an easy business. But it's a simple, predictable business model if you know what to do.
Well, and you know what, Scott? Whether it's self-storage, I tell you what's been my experience, and you can back me up or disagree with me. Whether it's self-storage, single-family houses, apartments, industrial, it don't matter. Unless you've got the cash, unless you've got the funding lined up, you might as well be, playing your guitar on the back porch, because it ain't going to do you any good. And of course, you're an expert as well as raising private capital. So I do not know, at least since I've been around doing this business since 2003. So you might as well say 20 years. Since I've been doing this business, I've never seen a time when it's been the most important to have your funding lined up for your projects. And here's what's beautiful. When you know how to do it and you have a system in place on raising your capital. And by the way, I've never asked for money. Never asked for money. I teach them and they chase me. But what's beautiful, even though now has been the biggest time to get your funding lined up because of opportunities, This should be the easiest time to get your money lined up because there's so much money on the street.
Yeah, there's a lot of demand, as we mentioned, coming out of Wall Street, and all eyeballs are on real estate because it is an income producing asset, and so there is, we want to call it a river of money that you just dip a net in. But if you know what you're doing, if you're a good sponsor, promoter, investor, those are all interchangeable terms, and you know what you're doing and you've got a good track record behind you, then the missing piece is your growth is limited to the amount of cash you have unless you know how to raise private equity and how to do it well and how to tell that story and then, be able to back it up. And so it is an art and a science, as we've said many times, Jay, as you and I both know, and there's a lot of pieces, and there's very successful syndicators out there and folks that raise private equity, and there's some folks out there that have swung and missed several times, and there's other folks that just shouldn't be doing it, and that's why we have the SEC around to police it as well. But I know you spent a fair amount of your career teaching people about that and really focusing on the SEC side and just, keeping people out of trouble and not stepping in their own stuff. But right now is a time where everybody wants to learn how so that they can grow and truly not take advantage in a bad way, but you take advantage of the market because we're heading into a time where there's a lot of people with a lot of money, as you said, that are looking for properties, which is what many of these folks do. So, tell me what that looks like right now. And if you don't have a sense of urgency, Storage Nation, I mean, you should. So Jay, what does that look like and what are the first steps that we should be doing right now?
So as far as getting the capital lined up?
Yeah.
Yeah. Well, first of all, don't try to figure it out on your own if you've never raised capital. If you're interested in self-storage, there's nobody better on the planet than Scott Meyers to hold your hand and his team to get you educated on getting your capital lined up. So in answer to your question, number one, I've preached it since 2009, and I'm preaching it louder than ever before. I don't care what asset class you're interested in. Get your money lined up. Get your capital lined up. The money comes first. Is there always going to be deals? Yeah. There's always going to be deals. There's always going to be of any kind of real estate deals, but the money comes first. Get your money lined up. So in addition to joining forces with Scott Meyers and learning what's in his head and his years of experience and getting money lined up and self-storage, which is stable in recession and non-recession. Scott, if you would allow me to, I'd love to give away my brand new private money guide that will help your people that are already seasoned and brand new people looking to get capital. And it's free. They can download it. Can I share that?
Of course, Jay, and I appreciate that. Yeah, what you got for us?
So I'm so excited. I just finished writing this. It's called 7 Reasons Why Private Money Will Skyrocket Your Real Estate Investing Business and Help You Build Incredible Wealth. And what's the wealth? I mean, that's the long-term, benefit, being able to do what you want to do when you want to do it and having freedom. You can download it for free. And again, I don't care if you're new or old. I've been doing real estate forever. Download my brand new private money guide at www.jayconner, J-A-Y-C-O-N-N-E-R, I'm an E-R, not an O-R, JAYCONNER.com /money guide, jayconner.com /money guide. And it really will help you get more private money or get your first private money lined up really, really fast so you don't miss out on any opportunities that come along.
Perfect. Well, Jay, we will put that in the show notes, everyone. Jay, I appreciate that because what people need is a guide. They need a roadmap, and it may seem a little bit daunting in the beginning, but don't miss this, folks. What we see right now is literally the biggest land grab in my lifetime as a real estate investor coming up right now, and we're prepared for it. And to Jay's point, I'll just echo and tack on to that when you need money, it's not when you find a deal. You need money way before that, because once you find a deal, you won't be able to raise capital fast enough before it falls out of contract. So it is.
I tell people all the time, Scott. I say the worst time to be attracting or raising private money is when you need money for a deal.
Yep. Doesn't work. It doesn't work. And people see that as well. And it'll be too late by the time you get it. So 100%. Well, Jay, as we end our time here, once again, it's sad, and it's always good to spend time with you as well. So I am looking forward to the time when we are in the room again together, as well as time when we get to chat about real estate. So once again, thanks for spending time with us today, Jay.
Scott, God bless you. And thank you so much for having me on. And I tell you what, you're my hero, because I know 10% of all of your business goes to building houses across the big pond for people that need it. And, you know, like you and I talked about it before we even started the show. Why are we in this business? Make a difference, make an impact, serve, and give back. So God bless you, my friend. Thank you for having me on.
Well, God bless you as well, Jay. Always great spending time with you. Thanks for your kind words, and looking forward to seeing you again. Take care, bud.
Bye-bye.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.